I think we're kicking it off. We're ready to start.
Let's do it.
Does everyone want to give an introduction starting from the end?
How long is this panel? 20 minutes, so I got about 19 minutes for an introduction.
Yes. Exactly.
Okay, that should fit. Hadley Stern, Chief Commercial Officer at Marinade. Marinade is a leading staking provider on Solana Network. A little thing that's unique about us is we actually don't run any validators. Instead, we connect a network of validators, providing those validators Solana stake to yield and giving stakers higher returns.
Great to be here. Hey everyone, Yubo Lee, Portfolio Manager at Grayscale. Really two focus for me. One is on active strategies, as I was managing the first active fund the firm ever launched, called Grayscale Dynamic Income Fund, which we leverage the on-chain analytics for the underlying proof of stake token selection, and also deliver the staking reward to our investors on a quarterly basis via distribution strategy. And additionally, my focus is on how do we enable staking on top of the ETF products and also the private placement products as well, as we think staking ultimately will be a default addition. And there's a very nice story behind it. It's not only you get additional return, you also help secure the underlying chain, which ultimately will benefit your token long-term capital appreciation opportunities. Yeah.
Hey, everyone.
Do you want my mic?
Oh, here we are. Sorry. Ben Spiegelman. I work at Figment. Figment, we typically say, is the leading staking provider, but since we're with other staking providers, we'll say a leading staking provider of infrastructure. We support about 45 different chains, have about 15 billion in assets, over 1,000 customers as of last week, so really excited about that, and hopefully to be helpful today talking to all of you.
Hi, my name's Phil Davis, and I work for P2P. We are the leading, no, just kidding. We are a leading institutional grade staking infrastructure provider at peak prices, which of course is not today. We had approximately 12 billion running through our validators. I am the head of the Americas, so I run reign over LATAM and North America.
And I'm the moderator for this panel. I work at Trace Finance. We do institutional grade reporting. We cover 220 blockchains. We cover not just claimed staking rewards, but generated staking rewards, which is really complex if you've ever tried to report on it. We do it for some, if not all, of the leading staking providers. And we also have a back office accounting portfolio management tool as well to help with companies manage their treasuries. And it's actually been quite exciting. I heard a lot of talk of reporting and regulation on the last panel, which normally you don't get to a lot during these conferences. But I want to start it out, do a little introduction, and then jump into the first question and hear what the panelists have to say. So staking, long central to crypto native yield generation, is now crossing into traditional finance via ETFs. With political winds shifting again in 2025, this discussion explores how asset managers are integrating staking into ETFs and what it takes to do so. So, first question. On May 29th, 2025, the SEC Division of Corporation Finance released a statement indicating that certain protocol staking activities and proof-of-stake blockchain networks are not considered security transaction under US federal securities law. Big win for us. How has that impacted ETF issuers' approach and timelines? And how has that impacted the validator infrastructure providers, their product and demand? So I don't know if we want to start with the validator infrastructure and how the SEC's change on not looking at staking yield as securities. So
Yeah, I mean, I can kick it off. A couple of subtleties to add to that guidance, were specifically around native and liquid staking. So importantly, the SEC did address and basically say that native staking was okay, but left restaking and liquid staking off the table for now. From a Marinade perspective, this fits in very well with our belief that native staking is the most appropriate way for ETFs to stake. No smart contract risk, and the underlying ETF can preserve custody on Solana of the underlying Solana. So we see this as a positive step. But for validators on the reporting side, your second part of your question, there are a bunch of other issues that we have to figure out from a regulatory standpoint, but basically this was a very positive move for native staking on ETFs.
Yeah, I can jump in just a little bit there. Just for like comparison, right? The Bitcoin ETFs as of today have about 125 billion, where the ETH ETFs have 10 billion, right? And so ETH as a comparison to Bitcoin is not like 8 or 9% market cap. It's much larger than that. And I think a huge reason why people haven't poured into the ETH ETFs is because there's no staking. So you're leaving money on the table, right? So the Bitcoin ETFs have had significantly more success. You guys could talk about that more, but I just think this is the moment that, okay, now when you actually make ETH staking in an ETF, the product becomes significantly more attractive. And so since this guidance, many of the issuers have now substantially increased their energy and their efforts around this topic, and at the same time doing it for Solana. And so that's sort of like the next catalyst was staking for the ETH ETF, and then also Solana coming shortly thereafter. And I think that'll really show our sort of overall like space, what staking's all about, right? Like no one in public markets really knows until it's in a public structure. And so until we have that first example, I think it's going to be really, really hard for us to be widespread, but that moment's coming, I think, very soon here.
Yeah, I think my experience is sort of mirror Ben's, certainly with all the asset managers that I speak to. One of the big sort of changes that we've noticed over the last sort of week, several weeks since that statement came out is that plans that were previously firmly on hold for these products are now very much no longer on hold, and they are now making significant efforts to really try to sort of visualize what these products will look like operationally, legally. There are obviously significant challenges here, which I'd love to talk more about, and I'm sure we'll touch upon later, certainly as it relates to liquidity. But yeah, that's what I'm seeing in the space since that statement, yeah.
Yeah, good chat from an ETF issuer perspective. I think this is definitely a very exciting outcome we see, which is back to the conversation we had with the SEC. Our team went to DC early April, have a pretty engaging conversation with SEC, and you can definitely feel kind of both the engaging spirit and also they definitely have the crypto native expert willing to learn more about how staking works, and especially very active on exploring the ways on how you can enable staking on top of ETF products. So I think as Ben mentioned here, currently the total Ethereum ETF in US is almost approaching $10 billion. With a 3% annualized reward, it almost leaving $300 million on the table that should be harvested by the US investors who invest in those Ethereum ETF. So I think the opportunity set here is huge, especially with the clarity on the security side within staking. It's definitely paved the way, and we're very excited for what's coming next with the potential to enable staking on top of ETFs. And also, Ethereum ETF alone have $300 million, but we have many more proof-of-stake tokens out there. So imagine how much massive revenue and return potential like this could unlock for investors that are looking to invest in crypto through the ETF structure with multiple advantages, but now with an additional one, which is the staking reward on top.
And I think one thing that was interesting that you mentioned prior is you're actually putting these tokens and capital to work by validating the network. So they're not just being held in a custodian somewhere, not being used to validate the network. So not only are you leaving the $300 million on the table, but you're not contributing to the security of the network, whereas if you're able to use this institutional capital to do both of those things, then one, earn more yield, right? Make it a little bit more a better investment to get into, but then also you're validating and contributing to the network, which is the whole point of this, right? So, and that was, I'm stealing Yubo's point that he had made earlier that I found was very interesting.
Can I add a little something to that? So,
yes.
This is very much a Marinade perspective, but it's something we consider very important when it comes to ETFs. If you look at Bitcoin, now 6% of all Bitcoin is held in ETFs, the majority of that in one custodian. And so if we start to map out what could happen with staking ETFs, one thing that we're very passionate about, I thought that was a cat, one thing we're very passionate about avoiding is concentration risk amongst staking ETFs, so that there could be a situation where there's maybe only 2 or 3 validators who are servicing the majority of ETFs. What would that mean from a security of the network standpoint?
Yeah, I don't know if we want to sort of. I'd love to talk a little bit more about that. I had a catch up with Ben just before we did the chat now, and really couldn't agree with you more. I think a lot of that concentration comes in and around the custodians. Certainly, a lot of the firms that I sit down and I talk with, the general attitude is, and this is an attitude I'm working hard to change for entirely selfish reasons, of course, but the general attitude is that we're just going to do this through our custodian. They see it as something that custodians should offer. And of course, the first name that comes to mind, we all know the ubiquitous Coinbase. I think Ben estimated it could be around 90% of all assets will just go into Coinbase for this particular instrument for ETFs, which is a bit frightening. It's a bit higher than I had hoped and I would project. But yeah, you don't need 51% of a network to start causing problems on that network. So in TradFi, we would call that counterparty risk. In DeFi, we call that centralization. It's synonymous. So yeah, it's a problem. It's maybe not necessarily one that the asset managers as yet necessarily recognize, but I've spoken to a few, and I think we've made some progress there. Yeah, and I think that's really, for the most part, how we're helping firms on the P2P side is really domain expertise and education. But yes, that's a big point. Yeah.
Perfect. And also feel free to jump in, because that's always the best. And then for the next one, from a validator infrastructure perspective, what does it take to support institutional grade staking in an ETF structure as comparative to, call it a fund manager or even retail? Like, what is the different level of either security or best practices or reporting that you have to meet in order to service these, type of institutions?
Yeah, there's a lot of different components that probably make it up. I think the first and foremost is the company itself has to be institutional enough, right? If you're like 8 people and you're using like an AWS server to be able to run your networks, like that can be super profitable and you can make a lot of money as a small validator like that. But you're not going to win the business of a BlackRock or a Fidelity or someone else purely just from a going concern risk and a trust risk. And so on the company side, right, it's things like having a SOC audit, having contingency plans, having a security team, all of those like standard things. When we talk to all these large companies, like Figment's the largest staking company in the world. We're 160 employees. We have a decently large balance sheet. They think we're absolutely tiny, right, compared to the typical counterparties that they deal with. So being of size, being large enough, having process, having contingency plans, all of that in place, number one. Number two, connectivity to the custodians. They all want to have, as you said, multiple custodians. So being able to actually have done the integration work with the large U.S. Institutional regulated custodians. There's really like 4 or 5 that probably are going to matter in the space. And so doing that is a really key component. You mentioned the rewards part. We use Trez Finance as part of our infrastructure as well for some chains. And so they've done a great job. It's about detailed level rewards reporting for every single delegator on a daily basis. That's not simple. It's not a simple thing to do. So making sure that we're doing that. And then sort of like the next phase, which is like, all right, you've now checked all the boxes. How do you give me the highest rewards, right? And so each chain is different. On Ethereum and Solana, there are things called MBV to be able to make your blocks more useful, more productive, higher in value. There's new innovations that's coming all along. So it's how can you provide the best rewards and do it in the safest way possible. And so a lot of different components, but it's all sort of a work in progress. And all of the stuff that we had to serve a $10 million VC was like a great starting point, but serving a $12 trillion asset manager, the demands are just much higher and the stakes are much higher. Pun intended.
Yeah, I think one thing I would like to share the thought on our side, especially through the ETF structure, is how much assets you are able to stake. Because ultimately you want 100% of the assets to be stakeable. But if you recall again back to the creation redemption nature of ETF, they do require daily liquidity. So how would you balance between the liquidity mismatch between the unbundling time of the underlying assets, for example, Ethereum, versus the daily creation redemption need, and also right now is T+1 settlement in US market. I think that mismatch on the liquidity side to introduce the active management on top of staking. Staking itself is not easy, and have the capability to manage on the liquidity could unlock even higher ratio which ultimately lead up to a higher deliverable staking reward for ETF investors. I think that's really the part we see. We're seeking a lot of partnership. I think with all the panelists over here is how do we enable and try to create a smooth workflow to enable a higher staking ratio, which lead up to a higher potential benefit and return for the ETF investors.
Yeah, so fundamentally, you need exactly the same thing for sort of Joe the plumber, retail investor, as you do for the institutions. The real difference here is scale. You need to be able to offer this at scale. So I think sort of Ben touched upon this. The short answer is that you need an extensive set of highly performant, robust, regionally, multi-regional deployed validators with institutional grade SLAs. You need a smattering of risk management that comes in the shape of insurance with provisions for slashing protection. That's essentially sort of what you need, yeah.
I never thought that I would want T+3 settlement back, right? Because then we could stake 100% of the assets and be fine on Solana.
I would just add that one of the products that we released in the first 3 weeks, it got almost 1 million sol staked to it, is our Marinade Select, and we have some partner validators here who are part of that, and that addresses a lot of the issues around institutional scale. So it's a set of 20 to 30 validators who were pre-vetted, go through KYC, AML, and that what's really beneficial, we believe, for ETFs there is it kind of auto scales because you have this incredible depth of validators who also would interestingly never sell to an ETF directly. They're professional Solana validators and they're very good, but they don't operate in that market. So that's that's how we've approached it. And then yes, the things like SOC 2 and compliance and those types of things are kind of table stakes.
Perfect. On to the next one. In terms of U.S. regulators and how they're interpreting staking income from your perspective, is it seen as dividend, interest, yield, other income? And then on top of that, when ETF issuers are thinking about staking awards in terms of NAV and yield distribution, are there any emerging standards for how this yield is going to be distributed and how it's going to be measured and returned?
Yeah, I could take it.
Maybe a little bit pointed.
Cool. Actually, let's do a quick survey for all the audiences here, because we definitely want to hear from the team. Because, as Victor mentioned, on the ETF side, once we get the staking reward, there are two ways we can deal with the reward. One is we accumulate back to the fund's NAV, which you do enjoy. Which you do enjoy the compounding benefits, right? Because you don't have to reinvest yourself. You can just enjoy from a total return perspective, which is the Cerio exposure plus the staking reward. And it just auto-compounding by itself. The other is you take a distribution of the staking reward in US dollars, similar to an equity dividend yield you receive from any of the equity ETFs you invest into. So those are the two common approaches. So I would like to hear from the audiences of, so the first one is if we make it a total return, you don't receive a distribution of staking reward, it auto-compounding back to the ETF. How many of you is in favor of that approach? Awesome. So probably around 50%.
For the cameras, most people raise their hands. Yeah.
Yeah,
Continue.
okay.
Sorry, I gotta narrate.
Okay, that's great feedback. And on the second, how many of you would prefer to receive a dividend similar to a dividend yield you receive from your equity ETF investment on the staking reward?
Two people raise their hands for the cameras.
Okay, that's
both was wanted. Yeah.
Just to riff on this a little, and I don't know whether ETFs could ever go there, but we actually just recently announced something called Marinade recipes, pun intended, where you can stake Solana, receive Bitcoin, receive any other kind of token, potentially in the future security tokens. So the idea being that you can pick what you want your stake yield. Mm-hmm. So I wonder if the ETF market would ever go to a space where I can stake in a Solana ETF but get Bitcoin in return, maybe Bitcoin ETF shares.
I mean, to me personally, that would be awesome. But I think the democratization for many of the structured products really leveraging the blockchain technology to make that to be a possibility. Because if you think about through a traditional finance angle, how hard it is to relate to what you mentioned here is once you receive Solana, could I convert that back into Bitcoin? Right? Just imagine how many agencies, centralized parties will be involved from the accounting, the reporting side will be involved to support this, while on the blockchain everything is transparent. And you can have a smooth transition of these, maybe leveraging the decentralized exchange and maybe even the DeFi activities. So I think we're getting there, but like this democratization is like a journey. It's always take time. But I really like that idea personally. Yeah.
And then coming from the reporting side, I could see how many issues and problems that could possibly create. And yeah, we were talking in the last panel. They were talking about how the blockchain was built for this kind of transparency and for reporting. And I promise you, it was not built with reporting in mind. Transparency maybe, but when these more complex products are coming out, in terms of, okay, I want to stake Solana and receive back, 5 different kinds of tokens, or I'm trying to bridge an asset from one L1 to 10 different L2s, or I want to have wrap Bitcoin, or I want to engage in all of these different types of yield farming. While the blockchain does record everything, it is inherently transparent. The data is really hard to access and even harder to contextualize. So, at least sitting in my seat, that's what I've seen being a huge problem to a lot of these. I heard Dell actually speaking about this at the Losses conference, where they wanted to accept Bitcoin, and they're like, we don't even know how to account for this, right? It's what is an auditor going to say? How are they going to check it? Like, how do we put this on our financial statements? Like, what kind of asset is this? Is it a liability? Like, I don't know. So as where these regulations are starting to emerge, and they're starting to become a little bit clearer, and the IRS has clarity and the SEC has clarity. Now it's not, hey, how do we report for this? But like functionally, how do we get the data and contextualize it? Which I've seen, become more and more difficult, and what 40 of our engineers are working day and night to try to do. And yeah, I don't know. Did you have anything else to add?
I was just going to say, I think the case for the total return, and for me, why I think I raised my hand, is because you don't invest in Ethereum to get 3%. It's not like you're investing in a stable asset and then you're happy to get a dividend like you would into treasury bonds. Like, you're investing into an extremely volatile risk asset. And then the 3% is bonus, right? If you're long the asset, then you're leaving money on the table if you don't stake it, 100%. But you're not doing it for a distribution to have steady income. Like, you're not advising your grandmother who's 85 to have an annuity based on their Ethereum staking rewards rate. Like, that's just like not the risk profile of the underlying asset. So like the total return thing is like, okay, I don't even have to think about it, right? I believe in this asset long term, and I want to be able to have the maximum exposure and value to that. So that was my thought on that one. Yeah.
And it's owning a piece of the network, right?
Yeah.
It's not just owning like a fiat that's just infinitely printed by the government, and you get some 3% return on it. It's owning a piece of the whole pie, right? Yeah. It's equity. Right. It's really equity in the network and equity in the underlying financial system. But no, yeah, I do not. My grandma always asks me how the selling of Bitcoin is going, and I tell her that I do not sell Bitcoin. I just report on it. But the last question that we have is, how are we seeing ETF issuers and also the validators shape regulation? Do you think there's been a lot more open conversations with the new administration and here in the U.S., globally as well? Because I know, most companies here operate globally. So I want to hear how those conversations are going. You don't have to say any specifics or name names, but just generally what the attitude with regulators has been.
Sure, I'll kick it off. I think at least a couple of us up here are members of the Proof of Stake Alliance, which is part of the Crypto Council for Innovation. And so that Proof of Stake Alliance has been proven to be very constructive and helpful in building relationships with DC. So I was down there, I think, a couple of months ago. We met with House, Senate, and the SEC as well. We'll be doing something again in a couple of weeks. There's white papers written, and that's been a very great way for us to advocate for the industry. So, the current SEC chief legal counsel who joined, Michael Selig, was in industry before joining the SEC, and he is probably one of the greatest experts in staking and knows it inside out. So I think there's good alignment and conversations that are very structured, and then I assume companies also do their own thing as well.
We feel exactly the same as the issuer side and as an asset manager, as we been keep advocating on the DC side and with regulators on how we can keep delivering those crypto native solutions for, especially for US investors and clients. I think exact same trend as Hadley observed and like you experience is they definitely onboard their crypto expert. Right? Not only try to learn how those processes work, but also make it truly engaging, actively discussing and try to figure out the workflow to enable many of the crypto native solutions that I'm pretty sure many of you enjoying using right now, but maybe through a more regulation channel like the ETF products or a private funds. So I think keep advocating for that, and staking is definitely, I think, the first stop for us to get into, bring more crypto native yield, crypto native solutions, like many of the on-chain ones, in a regulated products, and there are many others to follow next.
All right, guys, I think we're wrapping it up. If there's any final 1 or 2 sentences you want to give, feel free to jump in now. But then I think that we can conclude this. Any particular piece?
No, thank you.
Amazing.
Great. Thank you.
Thank you very much.